Hi, I'm David Grossman, the host of Keeping It Real. Welcome. We have a great show for you today. I'm glad you could join us. I'll tell you who we've got with us today in the studio. First up, we have Shaun Hildebrand. He's a senior market analyst with CMHC. Got some interesting things to talk to about Shaun. What is happening with the real estate market? There's a lot of talk about a bubble. Well, we've been hearing about a bubble for a long time. But is this the real bubble? It certainly seems that way, looking at some markets across Canada. Vancouver market, is Toronto going to follow? What is happening with the condo market? Is it overbuilt? We're going to talk to Shaun about that. A little bit later in the show, we have Eric Putnam. He's the Managing Director of Debt Coach Canada. There's a company that's growing. Debt is growing leaps and bounds. And Eric, his company will help you. It's like the health club for your wallet. That's what the company goes by. And nowadays, with more people running into problems, keeping up with mortgage payments, credit card payments, and whatnot, his company is becoming more important than ever. So that should be an interesting discussion. Let's start off first with Shaun. Shaun, welcome. How are you doing today?
I'm good, thanks. Thanks for having me.
Glad you could make it. So Shaun, tell us, I know your specialty is the GTA market. Mm-hmm. Tell us, what do you see happening here? Are we finally at that bubble? Are prices going to level off? Are they going to go down? Where are they going from here, do you think?
Well, I think if you look at some of the recent statistics, it's showing that the market is already starting to show some moderation. So we saw quite a bit of a run-up in activity over the last few years. And now you're starting to see a little bit more balance in the market. We're starting to finally see some listings come online. Mm-hmm. And at the same time, sales are starting to fall a bit. So it's creating a situation where housing prices don't necessarily have to rise by the same extent that they have been. And that's a good thing, particularly for first-time buyers, as affordability has become more challenging. Regardless of the fact that interest rates remain at historic lows, housing prices have been growing much quicker than income levels for really the better part of the past 10 years. So this is weighing on affordability for relatively younger households looking to get into the market. So what we're seeing now, the bit of a break in the run-up in sales and the run-up in prices, I think is good for the overall longer-term stability of the marketplace. It'll help to kind of improve affordability in the near term. And as interest rates do inevitably begin to rise, even if it's not this year or perhaps next year, the fact that housing prices are beginning to level off now will lessen the bite on the market, so to speak.
Okay, you talk about affordability and the opportunity that first-time buyers have, for example, to get into the market. But that is also hampered, I think, to a large extent, or impacted to a large extent, by mortgage rules which have been tightening. Why is there this tightening of mortgage rules? It seems to be getting harder and harder for first-time buyers to get into the market as a result.
Well, I think the decision to change a mortgage policy came from some statistics that are showing that a growing number of households who have been getting into the market over the last little while, will have a tougher time meeting their mortgage obligations when interest rates do begin to rise. So it was more of a preemptive move to lighten any sort of negative consequences that are going to come as a result of rising interest rates. Right now, the market is stable. If you look at the percentage of households that are in arrears, so that would be 3 months or more behind a mortgage payment, in Ontario, it's about 2.2% or something like that. It's one of the lowest levels it's ever been. That's 2 out of every perhaps 1,000 mortgage holders that are behind on their mortgage payments. So the quality of mortgage credit in Canada is very high. And the measures that we're taking today, I think, are quite prudent to make sure that credit quality remains high and the market remains stable, and we don't end up with a problematic level of supply in the market like what happened in the U.S. So the arrears rate in the U.S. is more than 10 times higher than what it is in Ontario. And obviously, you've seen what's happened there. There's an oversupply of homes, and it's going to take them a while to work their way through it.
What about the condo market? I have a friend, he's a real estate agent. He works the Liberty Village area, and he was big on these assignments where it's, foreign investors are coming in, they're buying up these units, they're selling them before they even close. Everybody's making money on these things. He feels that market is drying up, and that in the next 12 months, the market is going to be flooded with condominiums, and people aren't going to be able to close. What are your thoughts on that?
Well, the supply situation in the condo market is one in which we're obviously seeing supply grow quicker than demand at this point. So if you take a look at housing sales recently across the resale market, condo sales are actually declining at one of the fastest rates, despite the fact that more supply is opening up on the marketplace. So this is a function of the fact that we're starting to see first-time buyers cut back. So they're cutting back at a time when more supply is coming on stream. So this obviously isn't good news for condo prices. They're starting to soften a bit. And active listings, unsold listings in the condo market are hitting new highs. So it's really starting to test, market prices for condos these days. And I do think that we've yet to see the real supply come on stream. If you take a look at pre-construction activity, we hit a record number of pre-construction sales last year. We're starting condos at a record pace. So the real supply that's going to come onto the market is probably going to happen around 2015, 2016. In the meantime, what we're seeing is that a lot of the units that are coming to completion are in fact being added into the rental market rather than listed for sale. So that's been a good thing. It hasn't added a lot of negative supply pressure to the market, which is why you're not seeing condo prices decline. They're starting to soften a little bit because of a bit of a moderation in demand, but you're not seeing a huge downturn. When you get into 2015, 2016, you're going to see a lot more investor-held units come to completion. At that point in time, the investor is going to have to make a decision whether to hold on to the unit or rent it out. And it looks to me that they're probably going to increasingly choose to sell because they'll probably not be able to generate any positive cash flow on the rental unit because condo prices have risen so much higher than rent levels. And the market is going to be softer than what it is today. They're not going to be seeing much capital appreciation. So I think in the near term, the condo market should remain relatively stable. Greater risks probably emerge a few years from now.
Okay, Shaun, I was doing a little bit of research online this morning, and there's a gentleman by the name of Ben Rabideau. I don't know if you heard his name. He writes a website called the Economic Analyst. And he was saying that CMHC is held back to an extent in terms of growing their total amount of loans that can be insured. The government used to be like somewhere around 350 billion, and it was growing at a pace of around 50 billion per year, and now they're close to 600 billion, which is their cap. So the idea being that these tightening rules are there in order to make sure that CMHC doesn't grow beyond this $600 billion cap. He's saying that means maximum growth of 10 billion per year in insured mortgages compared with previously 50 billion per year, and that means a serious impact on the activity in the market. Do you have any thoughts on that?
Well, I think it's first important to point out that a lot of the growth, the recent growth in that cap, in reaching towards that cap limit, has come from what they call bulk insurance. So this isn't necessarily high ratio mortgage deals. These are in many cases low ratio mortgage deals. So a huge demand from lenders to get insurance wrapped on their product and then securitize it into the marketplace. So that business is beginning to slow down. We're backing away from those types of deals. However, the high ratio mortgage, which is obviously very popular amongst first-time buyers, isn't expected to be impacted at all. In fact, the growth in that business is going to be matched by turnover as well. So it's not believed that it's going to impact first-time buying demand and housing sales in that way whatsoever going forward.
Okay, gotcha. We had one or two people write in with questions yesterday, so I just wanted to share those. I know one of them you said that it's not something you commented. It's the it comes up to the Minister of Finance. So I'll go to the Minister of Finance for that one. But just in fairness to our audience, I'll put the question out there so that people know that we don't ignore their questions. And it's a Robert Storing from Century 21 Lanthorn Real Estate. He's talking about CMHC reporting and Minister of Finance reporting that they want to slow the market and in centers like Toronto, Vancouver and Calgary, but there are some areas of the country they're actually in a real estate recession, but no one seems to care. Why can't lending rules be changed for large centers of population and leave the rest of the country? So, according to what you said last night, I don't know if you have any further updates on that one. We can leave it alone if not, but I'm just putting it out there because, as I said, for integrity for my viewers, this is a call-in talk show. So your comment on that is that we need to go to the...
Yeah, I think the decision behind that mortgage policy change obviously should be directed to those that make the decisions. But a couple of things to point out is that obviously federal policy has to be followed by the entire country. And as I mentioned earlier, it's not so much a matter of slowing down the housing market, it's making sure that people aren't overextending themselves as they get into the marketplace. So making sure that they are prepared for the fact that interest rates aren't going to remain low forever.
Right.
And making sure that the income that they have is going to be there to support higher mortgage payments in the future. So really, it's just it's a prudent step to make sure that mortgage quality remains quite high in the country.
Right, I understand. Well, I mean, I've often thought that isn't it amazing that CMHC is willing to insure deals on to high ratio mortgages in smaller towns where the risk is higher, and how fortunate people would be in smaller towns. So now that I guess there's a tightening, they feel the shoes on the other foot, I guess, so to speak, and so now there's some pain out there. I will follow up, Robert, with the Minister of Finance on that. See if we can get somebody from the ministry to comment or possibly even come on the show. There was another question, and that is from Lydia Ingalls. From Century 21 Heritage Group. She was writing in, she says, where will a senior on a pension be able to live based on $1,298 a month if they're lucky? And this would have to include all their utilities, food, and so on. She sits on an affordable housing task force at the Toronto Real Estate Board, Shaun. So that's something of a concern to her. Is there anything that CMHC is doing or could be doing to help people in this respect?
Yeah, I mean, it's difficult to comment on personal situations, obviously, but in general, the rule of thumb is that your housing costs shouldn't exceed 1/3 of your gross monthly income. So in this particular case, your housing costs shouldn't be exceeding something around $450 or so a month, which is obviously quite unrealistic to find housing in the city of Toronto. If you take a look at average market rents, the average bachelor goes for about $900 or so. However, there are options, and we were in fact discussing this before we went on air, that cohabitation is in fact becoming increasingly popular. So the average 2-bedroom goes for about $1,100 or so a month, but if you go to, say, the northwest end of the city, you can get a 2-bedroom apartment for around $950. So that could make sense.
Right.
There are some affordable ownership and affordable housing policies through the city of Toronto, and however, it's quite limited as well. The waiting lists I hear are quite long. So that might not be a feasible option. But we do have a lot of information on affordable options and affordable housing programs on our website. And I do encourage whoever's interested in that subject to visit the website and contact that department to speak about it in more detail.
Which of course is cmhc.ca.
Exactly. Yeah.
Shaun, I want to thank you very much for joining us today. It was very much appreciated. And thank you. Hang in there. We're going to be back in just a couple of moments with Eric Putnam to talk about debt. Hang in there. Be right back.